Imagine this for a second. You spend your entire life playing exactly by the rules. You wake up early, you do the grueling commute, you sacrifice those little luxuries, and you diligently funnel a piece of your hard-earned paycheck into a 401k for 4 decades. You do everything the experts told you to do. And finally, you cross that finish line. You look at the account, and boom, you are a millionaire. But instead of feeling this immense, overwhelming freedom, you just feel paralyzed. You are gripped by this terrifying, invisible fear of actually spending your own life savings. You're trapped by a rigid, unseen system that was designed from the ground up to keep you hoarding your wealth until the day you die. Welcome to USA Rift. Today we are completely exposing the mechanics of the great retirement illusion.
Look at this real quote we pulled directly from a retiree who was desperately asking for help on a financial forum. "I'm 60 with $1.5 million in my IRA. Can I still retire?" I really want you to let that sink in for a moment. Think about the psychology here. Here is someone, a former teacher maybe, or an office worker, who successfully amassed over $1 million in liquid wealth, and they are absolutely terrified. They are essentially begging strangers on the internet for permission to live their life. They've already won the game, yet they feel like they are constantly teetering on the edge of financial ruin. So why does this happen? Because the traditional financial industry has brilliantly engineered an entire culture of profound, paralyzing anxiety.
So I'm going to ask you a very uncomfortable question right now. You're not broke because you spend too much, but are you actively hoarding your wealth because the system completely lied to you? We're going to look behind the curtain today, and it is going to change how you see your money. We are going to meticulously break down the bloated helpers of the financial industry, the absolute mathematical lies of traditional retirement rules, and the hidden structural traps that silently bleed your accounts dry while you're sitting at home too afraid to even take a vacation.
For decades, the financial industry has preached the absolute gospel of the so-called 4% rule. Now, on the surface, the math seems simple enough, right? If you have a $1.5 million portfolio, you are told to withdraw exactly 4% in year one, that is $60,000. And then, according to this totally outdated rule, you just blindly adjust that $60,000 for inflation every single year for 30 years. It doesn't matter what the market actually does. Imagine the reality of this for a second. The stock market is violently crashing. Inflation is suddenly soaring at 8%. Your roof is actively leaking. And this rule demands you withdraw a rigid, unyielding, flatline amount of cash. It's an illusion of safety. Actually, scratch that. It's not even an illusion. It's just completely disconnected from reality. It ignores how real money and, more importantly, how real human lives actually work. It pretends that a vibrant, chaotic, dynamic 30-year retirement can be boiled down to a static spreadsheet from the 1990s.
And to enforce this fear, the industry relies on a tool called a Monte Carlo simulation. Now listen closely to how this seemingly objective mathematical tool is actually weaponized as a psychological trap. Advisors take your portfolio and they run it through thousands of randomized market scenarios. Then they sit across the desk from you and tell you that you absolutely need a 90% success rate or higher to be safe. But let's pause. What does a 90% success rate actually mean in the real world? It means that in 90 out of 100 scenarios, you die leaving behind a massive, untouched pile of unspent money. To achieve that incredibly high artificial success rate, the system literally forces you to drastically underspend right now. It forces you to live far beneath your means just to ensure that your advisor's assets under management stay artificially inflated for as long as possible. You aren't avoiding failure here. You are just avoiding living.
Part 1. Sequence of returns risk.
Okay, let's dive into this. Because to truly break free from this trap, we have to deeply understand the actual structural danger that traditional rules completely failed to solve. It's the single biggest threat to any traditional retirement portfolio. It is called sequence of returns risk. Here is how it works. If you experience a massive market crash in year 25 of your retirement, it honestly barely matters. Your wealth has already spent decades compounding, you're fine. But if you experience a market crash in the very first 2 or 3 years of your retirement, it is absolutely devastating. Let's look at the granular math. If your portfolio drops 20% and you still rigidly withdraw that $60,000 under the 4% rule, you are forcing yourself to sell massive amounts of your shares at rock-bottom prices just to generate that cash. Selling 1,000 shares when the market is at an all-time high? Perfectly fine. But to get that exact same $60,000 when the market is down 20%, you might have to sell 1,500 or even 2,000 shares. And here's the kicker. Once those shares are sold, they are gone forever. They can never recover when the market bounces back. You have permanently destroyed your future compounding power. You literally cannibalize your own nest egg. This early sequence risk creates a deep, lingering psychological fear. It's the boogeyman that keeps retirees awake at 3 a.m., and it is exactly what traditional flatline withdrawal strategies are entirely unprepared to handle.
Part 2. The price of advice. So you have to ask yourself, who actually benefits from all this fear? If you are too terrified to manage this sequence risk yourself, who inevitably steps in to save you? We need to expose who is truly profiting from keeping your assets locked up in a state of perpetual anxiety. It's the bloated army of financial helpers. The crucial point we need to understand here is the absolute mathematical devastation of the assets under management, or AUM, fee model. Let's look at the smallest details, because this is exactly where your wealth is silently extracted from you. Many advisors charge a 1% AUM fee. Now 1% sounds tiny, doesn't it? Like a rounding error. Who cares about 1%? But over a 30 to 35-year retirement, that tiny 1% fee, when you factor it against the compounding growth you are actively missing out on, silently bleeds away nearly half of your potential retirement income. Let me repeat that. Half your balance, gone. As one of our sources noted, about a 2% fee, the destruction is catastrophic. But even at just 1%, it's staggering. And here is the worst part. When the market goes up, the expert takes a cut. But when the market crashes by 20% and you are sick to your stomach losing sleep, the advisor still takes their exact same fee from your remaining balance. They never take a loss. You take 100% of the risk. They take a guaranteed, risk-free skim off the top of your life's work.
We are fiercely dedicated to tearing down these illusions and showing you exactly how the financial system operates behind closed doors. You are watching USA Rift. We rely entirely on viewers just like you to keep exposing these hidden truths. So please, pause for a second right now, subscribe to the channel, like this explainer, comment your thoughts down below, and support our deep dive investigations by becoming a channel member. It makes a huge difference. All right, let's get back to the truth.
Part 3. Guardrails, the dynamic solution.
The elite, the truly informed people who know how money really works, they do not use the 4% rule. They do not sit around living in fear of arbitrary Monte Carlo failure rates. They use dynamic, highly empowering strategies. Let's look at the actual mechanics of how to protect your wealth, starting with something called the Guyton-Klinger guardrails method. This is how you completely eliminate that cliff-edge fear of failure. Let's break down the exact, granular mechanics of how this functions. Instead of demanding a rigid $60,000 forever, you set flexible guardrails based on your portfolio's actual real-time performance. Let's say you have $1.8 million and you start by spending $11,200 a month. Life is good, but then the market crashes and your portfolio drops 14% to $1.548 million. Under the old system, you'd panic. Under this system, you simply hit the lower guardrail. You don't go broke. The system simply triggers a very measured 7% spending cut. You reduce your spending by just $784 a month. That's it. A small, calculated, totally manageable adjustment. It is not a catastrophic failure. You adjust dynamically to the reality of the market, which completely neutralizes that terrifying sequence of returns risk we talked about earlier.
And this brilliantly illustrates the true, life-changing power of guardrails. Because it's not just about surviving the bad times, it's about fully capitalizing on the good times. If your portfolio grows much faster than expected in a bull market and hits the upper guardrail, the system literally tells you to give yourself a raise. It triggers a mandatory increase in your allowed spending. You take that long-delayed trip to Italy. You help your kids out with a down payment on their first house. You actually live your life, instead of unnecessarily hoarding your resources and drastically underspending just to keep your financial advisor's AUM fees inflated. Guardrails turn your stagnant money back into actual living.
Part 4. Lockboxes and glide paths.
But what if we could take this even further? What if we could bypass the traditional investment markets and the fee-hungry advisory industry entirely? Enter Nobel laureate William Sharpe and actuarial professor Piet de Jong. They propose a radical, massive structural alternative to the traditional retirement glide path. It's a system that completely rewrites the rules of how wealth is managed. This is the lockbox strategy. Let's detail the exact mechanics here because they are absolutely fascinating. Imagine that starting at age 30, you were required to put the first $5,000 of your annual retirement contribution into a highly aggressive, ultra-low-cost ETF lockbox. But here is the catch. This lockbox literally cannot be touched for exactly 35 years. So at age 30, you buy a lockbox specifically for age 65. At age 31, you buy a lockbox for age 66. Because this money is physically locked away for 3.5 decades, it completely drowns out all those terrifying short-term market gyrations. You don't need a high-priced advisor to hold your hand and manage your risk, because the 35-year time horizon mathematically neutralizes the volatility for you. You literally cannot panic sell your shares even if you desperately wanted to, which eliminates human error and emotion from the equation entirely.
Now, let's look at how this builds over time, because this is where the highly granular, behind-the-scenes actuarial magic really happens. This system uses a sort of virtual ATM and something called cohort shares, or C shares. Let's break this down very simply. If 100 people all buy a lockbox at age 30, statistically speaking, a few of them will unfortunately pass away before they reach age 65. In our current traditional financial system, what happens to that money? An insurance company or a massive financial institution quietly pockets those unredeemed funds as sheer corporate profit. But in the C-share system, that money is pooled together. It stays inside a sort of lost and found chest and is divided entirely among the surviving members of that exact same age cohort. You are essentially getting a massive, compounding yield generated by the natural, unavoidable math of human lifespans. This shared mortality structure naturally generates the massive amounts of capital required to fund expensive, late-stage aged care for the survivors, and it does it without requiring a single dime of predatory, expensive insurance fees. If we scale this brilliant concept up to the macro level, the implications for our entire country are staggering. Research models actually suggest that if the shared lockbox structure had been fully implemented 35 years ago, it would be saving the government an estimated $30 billion annually in age pension and aged care support today. Think about that, $30 billion every single year. By simply automating the accumulation and distribution of wealth through index lockboxes and C-shares, we totally bypass the fee-hungry financial middlemen. That bloated army of helpers we talked about, they become entirely obsolete, and everyday American workers actually get to keep the wealth they spent their entire lives generating. Part 5. The Retirement Spending Smile. Now, we must move to the final and perhaps most important psychological realization about how human beings actually behave with money over time. Everything we've talked about up to now, the 4% rule, the Monte Carlo calculators, all of it rigidly assumes your spending stays exactly the same, just ticking up for inflation until the day you die. But groundbreaking research by David Blanchett reveals this is a total fabrication. It's called the retirement smile. When we map out the timeline of a real human life with extreme detail, we see 3 very distinct phases. First, you have the go-go years. You retire at 65, you are healthy, you have tons of energy, you want to travel the world, buy a boat, spoil the grandkids. Naturally, your spending is high. But then, as you enter your mid to late 70s, you slowly transition into the slow go years. You've already taken the big trips. You start preferring the comfort of your own home. You aren't buying new cars every few years. During this long phase, your real, inflation-adjusted spending actually drops significantly. Finally, in your late 80s and 90s, you enter the no-go years. Spending ticks back up rapidly, forming the upward curve of a smile driven almost entirely by late-stage medical and assisted living costs.
And here is the absolute most shocking conclusion of this spending smile research. Because human spending naturally and predictably dips in those middle slow-go years, you actually need roughly 20% less in retirement savings than the rigid flatline calculators demand. 20% less. Let that sink in. The traditional calculators, the terrifying 90% Monte Carlo success rates, the AUM advisors hovering over your portfolio, they're all systematically demanding that you oversave and underspend by a massive life-altering margin. They are locking up your capital out of a phantom fear that entirely ignores the absolute reality of human aging.
We dive into the absolute smallest details on this channel because that is exactly where the financial industry hides its massive profits. In the obscure math you aren't supposed to understand. If you value this kind of deep dive, no-nonsense explainer, you know what to do. Subscribe to USA Rift, like this explainer, leave a comment down below with your thoughts, and hit that join button to become a channel member. Your direct support is literally the only way we can continue to bypass the noise and bring you these unvarnished financial truths.
The system was never designed for you to win. It was meticulously designed to keep you saving, keep you terrified, and keep your hard-earned capital under their management for as long as humanly possible. And the absolute worst part? Most people will never realize it. They will follow the rules perfectly, and they will die the richest person in the graveyard, having lived a tragic life of artificial scarcity. Well, the veil is finally lifted. Will you let the system keep your wealth, or will you finally live your life?